Ian Harnett of Absolute Strategy Research says equities are looking cheap, but how easy is it to unlock that value?
Well, I think we're going to be seeing that over the next couple of days, aren't we? Certainly the rally that we're having last night in the States and today, following through in Europe, people are trying to get the bottom here. But what we've seen is that it is very dangerous, and I think it's particularly dangerous when we don't quite recognise or understand which of these three factors has really been driving the markets down in the last 2 weeks.
And that's precisely the problem right now, isn't it? Because it makes it very difficult to predict the bottom.
Yeah, I think picking the bottom is tricky, and then picking the winners as you come out as well is particularly difficult. So we've seen over the last week some of these cyclical stocks have actually been some of the best performing stocks in Europe. But if it is about synchronised global slowdown, then that safe haven that people have been looking at over the previous year and a half, they're going to be having a tricky time in the recovery. The initial phase will be great, but further out they'll have a bit more of a headroom to butt up against.
I know that you say it's a combination of different factors that has led to these steep declines, but if you had to choose between the general raft of weak data that has generated this concern about a global slowdown and then the political aspect of all of this, the inability of the politicians, first in the US and now here in Europe, to actually take decisive action. In Europe, that means Eurobonds, fiscal union, which would it be?
I think it's the interaction of all three of those. So I think that what we saw was that US money funds withdrew about $60 billion of funding on the numbers that we've been able to identify, as fears intensified about that political uncertainty surrounding the ECB. And that on top of some of these very, very weak PMI numbers, not just from Europe, but areas like China, Brazil, Russia, those BRIC economies seeing their PMIs drop below 50. All of this has just come to a perfect storm. That said, valuations are very, very cheap. They're very attractive. And it really just depends on the time frame for yourselves as investors as to whether you want to be, or whether you're able to take advantage of that to invest for a 6-month view, 1-year view, where unequivocally markets are going to be higher, or European equity markets, we believe, will be higher, compared to that 1-week, 2-week view, where what we've seen in previous crises is you get big risk aversion, a bounce back, and then a reassessment and perhaps a retesting of some of these low points.
I mean, speaking of previous crises, do you see similarities with 2008?
Certainly. The way that we've seen the financials, particularly in Europe, hit over the last week suggests that financial influence is important. There has probably been some kind of financial dislocation taking place. The trouble is, with this politicisation of capital, we've seen it overnight, with these bans on short selling, you're actually having to bet on the political outcomes, not invest on the fundamental markets. And that makes it a very tricky environment for genuine investment as opposed to just punting.
Okay, and just a quick one on the general catalyst for the collapse. Would you say that it is European equities that are very much at the centre of this crisis?
Let's put it this way. Of the 54 global markets, developed markets that we cover, 30 of them are down more than 20% from their peak, or were a day or so ago. 15 of those, so half of the global developed markets that are in that bear market territory, are European. So Europe is at the centre of this. The financials in Europe have been at the centre of this, and some financial dislocation. So we have to see a combination of that financial dislocation being unlocked, and the ECB probably did quite a good job of doing that last weekend. But then we need to see the political environment made much clearer, and perhaps we need to move towards this end game of Eurozone bonds.
Well, the ECB said that those measures were temporary anyway. So, I mean, let's start with that. I mean, next week, impossible to predict.
I think that's what we've got to focus on. It is very difficult to trade in this environment. I think it's quite tricky. Investing, as I say, is slightly easier. Valuations are very cheap. I think one of the reasons why we saw some volume coming through in the States is that when you look at the comparison of dividend yields relative to what you can get in cash or bonds, equities look attractive. Very simply, we've got a yield on the European market now of around about 4.9%, and that's set against yields at 2.25%, and even the broader Eurozone yield at around about 3.9%.
So, Caroline, I mean, value there, are we seeing signs that people are getting in on it?
Well, after the sell-off in France, we've seen dividend yield, you mentioned, 9% almost, 8.99% for the French CAC, compared that to about 3% on French government bonds. But if people are going to start, if we're going to see government intervention, if we're going to starting to see banning on short selling, does that just destabilise things more?
I think what the concern is that if these shorts have been used for genuine hedging, then it could actually provide some destabilisation. If it has just been an aggressive trading strategy, then it should actually stabilise things. I think that what we're looking for now, however, is real money to start to come back into these markets, to see some reallocation from the big institutional funds in terms of asset allocation to take some of that money out of bonds and put it back into...
So when might that happen?
Well, I think that these things take time. Committees have to be convened. Expecting that to come through next week, I think, is actually, pretty unrealistic.
Great. Thank you so much, Ian Harnett of Absolute Strategy Research.